I'd like to start with this morning's data, an unexpectedly large jump in the consumer price index. That started, or at least contributed to a debate on Wall Street about whether all the stimulus that's been pumped into the economy is inflationary. Some people even talking about the possibility of stagflation. Are those bad takes, or is it a reasonable discussion to have?
I think it's very premature to be concerned about a significant increase in inflation. I would say I'm still actually concerned that we're going to have difficulty reaching our 2% inflation target. So remember, inflation is a sustained increase in prices. I think what we're seeing in some of the monthly reports is some things have been a little scarce as a result of the pandemic. Other things are in abundant supply. And we're seeing things like airline tickets and some other areas where it doesn't really reflect robust growth, but actually reflects the cost structure that occurs while we're having a pandemic. So I think there are going to be relative price changes that from time to time increase and make the reported numbers seem larger. But right now, with 10% unemployment, I'm not particularly concerned about inflation growing at a rapid rate.
On the growth side, there seems to be a growing feeling that we might see a resurgence of the virus this fall, and that would hit GDP, that would hit growth. You were very strong this morning in saying the U.S. in many places opened up too quickly.
The economy is very closely tied to how the path of the pandemic goes. And so in the talk that I gave, and the charts are available on the Boston Fed website, I looked at Europe versus the United States. Europe ended up taking a big hit because they had very significant shutdowns. But now they're out and about much more than in the United States because they've been able to control the pandemic better than the United States as a whole. I then compared the state patterns. And so what the state patterns show is that those regions of the country, particularly in the South and the West, that opened up very quickly and with somewhat abandon, ended up getting a short-term boost to their economy, but it also increased the infection rate quite significantly. And as the infection rate has increased, people have changed their behavior, and either through changes in state mandates or changes in people's behavior, they're doing less spending, they're less mobile than they were. And so you see in the data that the New England and Mid-Atlantic states are now doing better because they had a more significant shutdown and were more restrained in how they opened up. I think as we get into the fall, that's going to be an important lesson to learn, that we need to follow the data very closely on what's happening with the pandemic. And if there starts to be an increase, we need to take more significant changes, either in our behavior or in the state requiring mandates that require that behavior.
Well, at least one of your colleagues has suggested the need for another lockdown. Would you go that far?
I think ideally it's much less costly to wear masks, to socially distance, to not be in big groups in poorly ventilated places. If we follow those guidelines, we can probably do less costly solutions than a shutdown. But if we don't either follow the guidelines by the CDC, and if the behavior doesn't change, in those parts of the country, the pandemic could quite possibly get severe enough that we run out of ICU units, and as a result of the capacity at the hospitals, have to actually shut down. I think there may be some regions of the country that are pretty close to that right now. I do think as the weather turns and it gets colder and schools are back in session, or at least some schools are back in session, the chance of the virus becoming more severe in the fall, I think, is substantial. I know the hospitals in the Boston area are preparing for another wave in the fall. I think that's probably true at most hospitals around the country. So I think this is a time to be quite vigilant. And I would highlight that being too relaxed now may have severe outcomes, both for the health and mortality of citizens, but also to the economy as well. So if you want a strong economy, we need to take actions against the pandemic that prevent the pandemic from shutting down the economy.
Well, given all that, what's your outlook for growth and unemployment through the end of the year, say? Have you changed it?
I've not changed my forecast that much. My own forecast is predicated on us having another wave of infections that were not effective in avoiding person-to-person transmission in a significant way. And I think that's going to result in either people's behavior or state mandates that slow the economy more than I would like to see. It's certainly much less costly than a shutdown, to take appropriate actions now. But it seems like our political leaders are fairly reticent to take those actions. And I think human behavior being what it is, many people have been less willing to wear masks, avoid social gatherings, et cetera.
Speaking of actions that the Fed can take, there's been talk of changing your forward guidance come September, perhaps to a state-dependent kind of guidance that would tie the Fed's interest rates to an outcome like inflation running a little hot for a while. Where do you stand on that?
I think there'll be an appropriate time to have forward guidance. I think at this stage of the recession and the pandemic, that forward guidance probably is only mildly helpful. And the reason for that is the long-term Treasury rate is still quite low, interest rates are quite low. And in that environment, I think people are already assuming it's going to be quite some time before interest rates rise again. So while it might be marginally helpful, I would actually say that our lending facilities and some of the facilities being run by the New York Fed are probably providing more support because they're getting at the cost of funds to individuals and businesses that I think are more important for what the outcome for the economy will be.
I want to talk about lending programs. Chairman Powell emphasizes, of course, that the Fed can lend, not spend. Is that the wrong prescription for the economy right now? Your lending programs have not seen a lot of take-up.
No, but they've been quite effective in many respects. So the announcement of our willingness to buy corporate securities quickly pushed those interest rates down. And as a result, we didn't need to buy very much because the market reacted to our announcement. So I would say credit conditions are much better than they were in March or April because of the Federal Reserve's actions. And I think that has been an important stimulus to the economy. In terms of spending, that has to come from fiscal policy. So the US economy also benefited from the kind of very quick and very significant stimulus provided by both providing better unemployment benefits, broader unemployment benefits, checks to low-income individuals. All those things have been very helpful in preventing particularly low-income individuals from being able to continue to make spending decisions over the course of the spring and into the summer. But I think many of those programs have ended as of the end of July. The pandemic has not ended. The unemployment rate is still above 10%. So we need stimulative fiscal policy to continue. I think that's critically important that Congress come up with some kind of agreement to continue to provide support.
Have you modeled the impact from the end of that fiscal stimulus?
My personal assumption in my forecast is that some form of additional stimulus is going to occur. It would definitely be bad news both for my forecast and for the economy if we don't do any additional stimulus at this time.
Back to the lending programs for a bit. The Fed last night announced it was lowering the fee charged for the municipal lending facility. Is that a sign that perhaps it wasn't properly designed?
No, I think it's a reflection of how much interest rates have moved down. So that program was designed as a penalty rate so that if a borrower was particularly stressed, they would find it attractive. But if they were not particularly stressed, they would not find it attractive. As market rates have moved down, it's quite natural that we move down with it. So I think it's actually a reflection of the success of the program that they're lowering the rate.
You supervise the Main Street program. That's perhaps the most controversial. According to your figures, $856 million in loans in the system, but it's a program that could do $600 billion in loans. Does that suggest modifications need to be made to the Main Street program?
Well, I'd highlight we've already made quite a few modifications. So we had an initial term sheet. We came out with a revised term sheet, and then it was revised once again to make the program broader and more accessible to a wider range of small businesses. We've also opened it up to the nonprofit sector. While we're not live on that part, banks are perfectly able to start the negotiations with the nonprofits. As you know, it takes a long time to actually negotiate a bank loan. So it doesn't surprise me that we would start gradual and that it would pick up over time. And so I think that's exactly what we're seeing. One reason we're seeing a lot of the lending coming primarily from community banks and mid-sized banks is they're probably a little bit more flexible and are able to adapt more quickly. I would expect that larger banks over time will start using the facility more. And the goal is to make sure that businesses that actually need it, that are creditworthy in February, that have had their cash flow disrupted and are likely to be viable businesses after the pandemic is over, are able to get that kind of cash flow financing. And I think we are seeing a pickup in that activity. I expect as borrowers and as banks get more familiar with the program, we'll continue to see increases. However, if we don't see the kind of increases that we would expect given the economic conditions, we've previously revised the term sheet. We could obviously do it again if the economy were to be worse off and the program was not to expand. That would be a time for the Treasury and the Board of Governors to rethink some of the parameters. But at this stage, I think it's premature to say that. I do think that we've been seeing a very significant increase over the last 2 weeks. I think that's going to continue. People hope that these programs happen instantaneously, but you can buy securities instantaneously. You can buy lots of corporate bonds, lots of Treasury securities, a lot of mortgage-backed securities. This program's getting in a part of the market that doesn't move quickly. It requires the borrower and lender to spend a lot of time negotiating. And the fact that the Federal Reserve's involved as well means that there's a separate set of legal agreements tied to the CARES Act, tied to the 13.3 facility. So it's going to take a little while for this to go up, and I think we have to be patient.
I guess the final question I'd ask is, how much of this do you think you'll end up using, in the sense of how bad is the economy going to get this fall that people would be coming to the Main Street facility?
Well, I think you're exactly right. It depends on how the economy progresses. And as I highlighted at the beginning of this interview, that depends on what happens with the pandemic. Unfortunately, since I actually think the pandemic is quite likely to get worse as we get into the fall, that means I am worried that the economy will get worse. That will mean that firms that were hoping not to need to access this program will probably need to access this program as both banks become more constrained and as businesses become more concerned that the disruption in their cash flow occurred much longer than they expected.